Hello all, I am William S. Jagetz with Family Financial Management Practice. We are a wealth management firm focused in the areas of tax planning and estate planning. Here on the YouTube channel, we talk about issues around legacy planning for art collectors and artists. I want to acknowledge these new acquisitions by artist Misty Sol, S-O-L, and there'll be links in the description. Today we're going to talk about 501c3s and how to reduce your tax burden via the use of philanthropic giving. So, right from the beginning, I just want to tell you 501c3s, giving money to charities, philanthropy, tax dodges. These are not just ways to not pay taxes. In fact, in order to not pay taxes on $1 million, you have to give that $1 million away. And then you've reduced your taxable income. So it'll save you between $300,000 and $600,000, depending on the rest of what your schedules look like. But in order to get any of that, you got to give away the $1 million. So anybody who tells you that, people who are giving money away and starting foundations, etc., are, just trying to selfishly dodge taxes, they're bad at math and probably not very generous or philanthropic themselves. But you are. So let's talk about it. IRS Code 501, Section C, Paragraph 3 is the 501c3 designation that we're all pretty familiar with. The part of the IRS code that talks about not-for-profit organizations or not-for-profit corporations. That includes public charities like the United Way, like in a lot of cases your local museums or the ballet company. Those can all be public charities. So they are organizations set up to operate and do a thing for the good of the community or a community, and they are tax exempt. And the other thing is the private charity, which is a foundation. So a family foundation, the Dodge Foundation, the Ford Foundation. They're all 501c3s. They all come under the same code, but there's two different things: public charity, private charity. Now, private charities don't have to actually operate like a public charity. What the private charity does is raises money that it then gives to other 501c3s that operate. So the Ford Foundation raises money and gives it to, theoretically, the Pennsylvania Ballet Company. I don't know that they do, but that's just the chain of how that works. So, how does this apply to you? If you give money to a 501c3, not-for-profit, then the money that you've given will be taken off of your taxable income, up to 60% of your adjusted gross income if it's a public charity, and 30% of your adjusted gross income if it is a private charity. So again, give away $1 million, and that's $1 million that you don't have to pay taxes on, but you did give away the $1 million. And how much of that million will be exempt is based on your adjusted gross income. Now, that's what happens if you give money to an already existing not-for-profit organization, any designated with a 501c3. So, why do some people, families, start their own not-for-profit corporations? What is the tax benefit of that? So, obviously, if you want to do good in the world, a lot of things that you want to do cost money. So that's why you give. You would start your own organization because you want to give in a way that's organized around things that you specifically believe in, and you want to know exactly where your money's going and what the activities are, how they're chosen, etc. If there's an organization doing something you believe in, you should absolutely give them some money. Empower the village. You don't need to set up a not-for-profit to do what they're doing. They're doing amazing things. Give them some money. Take the tax deduction. That's the easy part. Here's why you should start your own. When you have your own not-for-profit, again, you get to decide what the parameters are, who gets money, who doesn't, etc., and what causes get funded. But you also get to deduct just basic kindness. Example, a lot of people do the GoFundMe now. So somebody in your neighborhood, their house burns down and they're in a bad way and they're staying in motels and the kids need toys and blah blah. So some good-hearted person starts to GoFundMe, the other good-hearted people contribute, and this family is, their plight is made a bit easier. You can't deduct that. That's not tax deductible. So you gave them $100, you gave them $500, you gave them $1,000. It's not tax deductible. If you have your own 501c3, in this case a public charity, then that $1,000 can come from your not-for-profit, and now it's tax deductible. And that's all, like anything that the public charity wants to engage in that is for the well-being of the community and that fits within the parameters of the organization's statement, which is important. So when you set that up, one, don't do it yourself. We can help you with that. But when it is set up, you want to talk about the parameters. Try to keep it broad so that you can help the family down the street, and you can buy uniforms for the Little League team, and all of that can be tax deductible. And a lot of just the general nice kind things that you do to help people out, guess what? It can be tax deductible if you run that money through your not-for-profit. As that entity grows, you have to employ people to help you to manage it. So maybe that's when you hire your kids. That could be an actual real job, depending on how much money's coming through there. Somebody can get paid $15,000, $18,000, $20,000 that comes off your taxable income, goes into the not-for-profit organization, and pays a salary to someone who organizes and administrates the work of that not-for-profit. Again, could be one of your children, could be your grandchild. It's a way to get your family involved in the important philanthropic work that you want to do. Now, that one, the public charity, up to 60% of your adjusted gross income is deductible. So the private charity, the family foundations, it's only 30%, up to 30% of your adjustable gross income. Reason for that is generally people in the upper stratospheres of wealth and income are doing the family foundations. So the tax people like to put the squash on that as much as they can. But it's still worthwhile to think about doing, because you can put money into your private charity and it can stay there and it's tax deductible. You only have to distribute 5% of your of the company entity's assets annually. So administrative costs are allowed because, again, it has to be administered, it has to be organized. You have to go to places and talk to people and find out what they're doing and whether or not it's something that you want to participate in financially, something that you want your family foundation to fund. So that travel, that communication, all those things, the stamps, etc., it's all deductible. So once you put that money into the not-for-profit, private charity, family foundation, again, you don't have to make decisions of what to do with it right away. You do have to give out 5% annually, but you already didn't pay taxes on it. So that's great. Put $1 million in there, give out $50,000 a year. You get the tax deduction on $1 million. And if you're giving away 50, you're probably spending $20,000 administratively, and the rest of it is in there, hopefully in an endowment invested for growth. So, and if your contribution exceeds the 30% or 60% of your adjusted gross income, it rolls over to the next year. So it's not lost. So yeah, put in 10,000, 30,000, put in 50,000, 100,000. If only 30, 35 of that 100,000 is deductible because your, AGI caps you there, you move it to next year. So it's not lost, it's not wasted. So you can always roll it forward. And again, you're not paying taxes on this money. You're not keeping it selfishly. You're doing good in the world. But you're using money that would otherwise have been squandered on taxes to do that good and to employ your family, if you should so choose, in doing that with you. So charity, philanthropy, things like that are the kinds of things that can get a family together on what the legacy is that they want to create. If you're an attorney, if you're a CEO, if you're whatever you are, your kids may not want to be that. So it might be hard to get everybody coalesced around the family business. But getting together on philanthropy, getting together on helping people and making your community better and strengthening the organizations and the other people who are doing those things, that's easy to get together on. So give that some thought. Family foundation could be a good idea for you and your family. Public charity, probably a good idea to have something like that set up, because you're doing these things anyway. You are helping people. You're helping people. It's what you do. We're good people, so you're not going to watch the world, people in your community, in your neighborhoods. You're not going to just watch them go south and not do anything to help. And when you do, guess what? Take a tax deduction on that. All of that is predicated on the fact that you will be itemizing. So that's a Schedule A on your attached to your 1040. If you are taking a standard deduction, none of this applies to you. If you take the standard deduction on your tax return, none of this applies to you. I probably should have said that in the beginning. That's okay. It's still useful information, even if you just found out it doesn't apply to you, because you're going to come up to where you are itemizing, and then you'll be able to make use of that. So how does this apply to art? Well, when you give assets, not just cash, but assets, to a not-for-profit, they are deductible at their appreciated value. So if you buy it for $8,000 and now it's worth $60,000, and you sell it, you got to pay taxes on the $52,000 in gain. If you buy it for $8,000 and now it's worth $60,000, and you gift it to the family foundation or the public charity, well, that's $60,000 deductible from your taxable income, up to the limit. So that's a better deal because now you're not paying the capital gains. But you did want to sell it. Well, if the not-for-profit sells it, there's no tax on that sale. So you gift it to your not-for-profit, to your charity, to your family foundation, and you have that entity sell it. Now the money comes in, the painting is gone. We're talking about art specifically in this case, but this applies to stocks, bonds, any asset, any appreciated asset or assets that have been appreciated in value. You can also give assets that have depreciated in value. That's great because the organization can sell those and use the money, but there's no tax advantage to that because it's depreciated in value. In that instance, anything that's depreciated in value, you want to sell because that's going to reduce your taxable income. So if it's going up, you give it to your charity. Let them sell it. If it's going down, you sell it and decrease your taxable income. So, again, this applies to stocks, bonds, other assets, but we're talking about art. So, if you have decided you're a long-time collector, and it is now, especially if you're a long-time collector, if you've been accumulating art for 25, 30, 45 years. I know of collectors who have been buying art for 50 years, and when they go to sell those, there's absolutely going to be a mind-boggling capital appreciation, which is great, except that you're going to get a bill for tax on the capital gain, which is going to be somewhere between 30 and 40% of whatever you just brought in from sales. You don't want to do that. You don't want to give those people that money. You want that money to go into your family foundation so that your children and your grandchildren can do good in the world in your name. That's a legacy plan, and that's a great way to do it. So, public charity does things. Family foundations fund organizations to help them to do things. Both of them have expenses. Both of them can employ people. In almost every case, you can employ your family. They're great vehicles for legacy planning and great ways to bring your family together around some philanthropic ideals. So, give that some thought. That's absolutely something that Family Financial can help you with. We can set up your not-for-profit, be it a public charity or a family foundation. That's part of what we do. And we can, help you with your taxes to make sure that you're getting the full benefits of the good that you do in the world. So, thank you very much. Please like, subscribe, share. Coming up, we're going to have an attorney talk to us about intellectual property rights for artists. That's going to be a really good one. So set the alert button for that. I also have a friend of mine who's worked for Sotheby's in the past. She worked for Phillips in the past. Now she has her own art consultancy. She's going to talk to us about selling art. So I just touched on it a smidge. Sell it through your public charity or private charity. But the actual mechanics of selling art, there's a lot to it because you can't just list that stuff on Craigslist or Facebook Marketplace. And she knows what all those twisty knobs do in that part of the world. So, again, set the alerts. You want to be here for that, and you don't want to miss it. You got some good episodes coming up, some good information. Like, subscribe, share. Thank you for being here, and I'll look forward to talking with you again soon.